What if I told you that the fate of the American auto industry in 2025 wasn't sealed by engineers in Detroit, but by politicians in Washington? How did a policy designed to protect American jobs end up shipping them north of the border? The year 2025 will be remembered in the annals of the American auto industry not for a revolutionary new model or a breakthrough in technology, but as the year the floor fell out. It began not with a single cataclysmic event, but as a slow, grinding erosion that quickly cascaded into a full blown crisis. By the year's end, the stark reality was measured in lost livelihoods and shuttered factory gates. More than 42,000 American factory jobs, once the bedrock of Midwestern communities, had simply vanished. These were not jobs lost to automation or the typical ebb and flow of market demand. They were jobs ripped away by a protectionist trade policy that backfired with devastating precision. The tariffs intended to shield American industry instead acted as a wrecking ball, shattering the intricate, globally integrated supply chains that had taken decades to build. The once humming assembly lines, monuments to manufacturing prowess, fell silent one by one. The logic of these tariffs was, on the surface, straightforward: make imported goods more expensive to encourage domestic production. But this calculus failed to appreciate the profound complexity of modern automotive manufacturing. The industry operates on a razor thin, just in time model where components arrive at factories mere hours before they are needed. A single vehicle is a symphony of thousands of parts sourced from dozens of countries. Tariffs on steel, aluminum, and a vast array of finished and semi finished components did not just raise the price of a few parts, they introduced a fatal grit into the finely tuned gears of the entire system. Shipments were delayed at ports, costs became unpredictable, and the seamless flow of materials that is the lifeblood of just in time manufacturing ceased. For Asian automakers who had invested billions over decades to build a robust manufacturing footprint on American soil, the new landscape was suddenly hostile and economically untenable. This led to a strategic pivot that would have been unthinkable just a few years prior. Automakers, who had once proudly touted their commitment to U.S. production, began to hedge their bets. The flow of investment capital, which had long favored states like Tennessee, Alabama, and Ohio, started to change direction, trickling and then flowing north to Canada. The Canadian government, sensing a historic opportunity, aggressively courted these disillusioned manufacturers with promises of policy stability, a welcoming trade environment under the United States Mexico Canada Agreement, USMCA, and substantial incentives to build out a burgeoning electric vehicle EV and battery ecosystem. For a Japanese or Korean auto executive, the choice became painfully clear: contend with an unpredictable and costly tariff regime in the United States, or move to a neighboring country that offered a stable, cost effective, and friendly platform from which to access the same North American market. For the American consumer, the consequences of this industrial earthquake were felt almost immediately and acutely. The dream of new car ownership, a cornerstone of the American middle class, drifted further out of reach. With production lines sputtering and import costs soaring, the inventory on dealer lots began to dwindle. The few new cars available carried sticker prices that had been inflated by the tariff pass through, a bitter pill to swallow for families already grappling with high financing costs. Monthly payments, the ultimate arbiter of affordability for most households, ballooned to unworkable levels. The result was a chilling effect on showrooms across the country. Foot traffic thinned and sales figures plummeted. The industry, it seemed, had been plunged into a crisis of its own making, shaking the foundations of a sector that is a vital engine of the American economy and directly impacting the financial stability of both its workers and its customers. The shock waves were just beginning to spread. As those shock waves began to ripple outward, the new car market seized up, forcing a desperate wave of would be buyers to turn to the used market, hoping to find a reliable, affordable alternative. They were met with another, equally brutal market shock. The scarcity that plagued new car lots had infected the pre owned sector, creating a vicious feedback loop, with new vehicles being prohibitively expensive and in short supply. Large fleet operators, rental car companies, corporate clients, and government agencies began to hold on to their existing vehicles for far longer than their typical replacement cycles. This decision, a logical response to market conditions, had a catastrophic effect on the supply of late model used cars. The river of 1 to 3 year old sedans, SUVs, and trucks that normally flowed from fleet sales into the consumer used market dried up to a trickle. Suddenly, the calculus of value was turned on its head. A 10-year-old sedan with high mileage, once relegated to the back of the lot, was now commanding a premium price. Practical, family friendly crossovers, the darlings of the American road, became ghost like apparitions on sales websites, listed one moment and sold the next. The inventory squeeze was so severe that it fundamentally altered the very nature of car shopping. It was no longer a matter of choosing a color or trim level. It was a frantic scramble to secure any viable vehicle before it was snapped up. Analysts issued grim warnings that this pricing pressure and inventory crunch would linger indefinitely, a persistent hangover from the tariff binge that would not ease until trade policies were normalized and production levels stabilized, a prospect that seemed increasingly distant. This turmoil was more than a temporary market distortion. It was the trigger for a deep structural reset of the entire North American automotive landscape. The old map was being torn up, and a new one was being hastily redrawn in corporate boardrooms from Toyota City to Seoul. Automakers were forced to confront a stark strategic choice, a fork in the road with no easy path forward. The first option was to double down on American production, an expensive and complex gambit to onshore as much of the supply chain as possible to dodge the very tariffs that were causing the chaos. This meant building new component factories, finding and vetting domestic suppliers for everything from microchips to transmissions, and fundamentally re engineering vehicles to minimize foreign content. It was a long, capital intensive process fraught with its own risks. The second option, as previously noted, was to heed the siren song from the north and shift capital and future projects to Canada. This was not merely about building another assembly plant, it was about integrating into a burgeoning ecosystem purpose built for the next generation of automobiles. Canada was offering a holistic package: access to critical minerals for batteries, government supported gigafactories, and a network of suppliers, all operating within a stable and tariff friendly trade corridor. This was not a single company's misstep or a correctable error. It was a fundamental reevaluation of where and how vehicles for the world's most lucrative market should be built. The tectonic plates of the industry were shifting, and among the companies caught directly on the fault line with the most to lose from the violent tremors were two of the most disciplined and successful giants in the industry, Toyota and Honda. So let's take a look at how those giants of the industry stumbled, sending shockwaves across the global economy. Toyota, a company renowned for its operational efficiency and long term planning, found itself in an uncharacteristically reactive position, forced into a desperate mode of damage control. The financial toll of the tariffs was staggering. The company issued a stark warning that the trade duties could slash nearly $10 billion from its bottom line, a figure that sent a chill through the investment community. This wasn't theoretical, it was an immediate and painful reality. The company was compelled to make double digit cuts to its operating profit forecast, a rare and humbling admission of vulnerability. The situation in its most critical market was so dire that its North American operations, typically a reliable profit center, swung from a healthy profit into a significant loss. In a conference call with analysts, Toyota executives confessed that visibility is poor, a stunning admission from a management team famous for its meticulous, forward looking control. A provisional trade deal hammered out between Washington and Tokyo offered a sliver of relief, softening the primary tariff on imported Japanese vehicles from a crippling 27.5% down to 15%. But this softened blow was still a devastating punch. The new rate was 6 times higher than the pre tariff rate of just 2.5%, a level that had underpinned decades of trans Pacific automotive trade. Faced with this punishing new reality, Toyota's solution was to aggressively accelerate its long standing build where we sell philosophy. The strategy was to insulate itself from the volatility of trade policy by deepening its roots in American soil. More than half of all vehicles Toyota sold in the United States already rolled off assembly lines in places like Kentucky, Indiana, and Texas. The company announced it would pour even more investment into its American plants, particularly in the critical areas of batteries and advanced electronic components, to further localize its production footprint. In the short term, however, Toyota made a crucial and costly strategic decision. Instead of passing the full burden of the tariff costs onto consumers by hiking list prices, the company chose to absorb the multi billion-dollar hit itself. It was a calculated move to buy goodwill with its loyal customer base, and just as importantly, with its vast network of American dealers who would be on the front lines of a consumer backlash over price hikes. But while this strategy may have preserved market share and brand loyalty, the red ink on the balance sheet told the real story. The billions in lost income reveal the immense strain that even a manufacturing powerhouse like Toyota was under. It was a high stakes waiting game, a bet that it could outlast the tariffs without alienating its customers. Honda found itself trapped in a nearly identical dilemma. With major manufacturing hubs in both the United States, particularly in Ohio and in Ontario, Canada, the company was woven deeply into the fabric of North American production. Its response to the tariffs was to reshuffle its continental production portfolio, shifting the manufacturing of high volume models like the CRV and the Civic Hybrid to be more concentrated stateside. The goal was to maximize the domestic content of its most popular vehicles to shield them from the harshest import duties. Yet, this was no simple shell game. The roadmap was clear, but the execution was fraught with complexity. The fundamental problem remained the supply chain. While a Honda Accord might be assembled in Marysville, Ohio, its intricate supplier network was still a global affair. Critical high value components like advanced electronics, hybrid drivetrains, and specialized engine parts were still largely sourced from Asia. Each of these components, when imported into the US, now triggered its own set of duties, adding layers of cost that accumulated by the time the finished car rolled off the line. Resourcing these sophisticated components from American suppliers was not a matter of flipping a switch. It would require years of development, testing, and investment to build a domestic supply chain that could match the quality and scale of the existing network. Honda was committed to the transition, but executives quietly admitted that the journey would be measured in years, not fiscal quarters. The giants were wounded, and their path to recovery was long and uncertain. But if the tariffs bruised giants like Toyota and Honda, they absolutely pummeled the smaller Japanese automakers, leaving them exposed, outmaneuvered, and fighting for survival. These companies lacked the massive global scale, deep financial reserves, and extensive U.S. manufacturing footprint of their larger rivals, making them acutely vulnerable to the trade policy crossfire. Nissan, a company already navigating a difficult corporate turnaround, was hit particularly hard. The financial impact was so severe and unpredictable that the company took the drastic step of halting its forward looking financial guidance altogether, admitting it could not accurately forecast its performance amidst the tariff chaos after flagging billions in potential costs. While Nissan's large U.S. plants in Tennessee and Mississippi provided a partial shield, its heavy reliance on imported components and, crucially, on its manufacturing base in Mexico created a complex web of vulnerabilities. Vehicles and parts crossing the southern border were now subject to duties that ravaged profit margins. To cope, Nissan was forced into a product triage. It began offering heavy discounts on US built models like the popular Rogue and Pathfinder SUVs in a desperate bid to keep them moving off dealer lots and maintain volume. At the same time, it quietly paused the import of certain crossover models built in Mexico, effectively allowing trade policy rather than consumer demand or marketing strategy to dictate its product cadence. It was a stark illustration of how geopolitics had hijacked corporate decision making. Subaru, a brand that had carved out a fiercely loyal following in the US with its all wheel drive crossovers, faced an existential threat. The American market was not just another region for Subaru, it was the company's lifeblood, its overwhelmingly dominant source of sales and profit. With limited global scale and a production model still heavily reliant on Japan, Subaru had very few strategic levers to pull. It was cornered, and it chose to swallow the bitter pill of direct price hikes, passing a significant portion of the tariff costs onto its devoted customers. It was a risky move that threatened to alienate the very buyers who had fueled its success. Analysts warned that billions in additional costs loomed on the horizon for Subaru unless it could execute a rapid and massive expansion of its U.S. production facilities in Indiana and, critically, localize the production of key components like its signature boxer engines and drivetrains, which were still almost entirely imported from Japan. Mazda, known for its stylish design and driver focused engineering, saw its North American strategy thrown into disarray. Its crucial manufacturing operation in Mexico, which served as a primary export hub to the U.S. market, was decimated. Exports from its Salamanca plant to the United States collapsed by a staggering half. This forced Mazda to lean much more heavily on its joint venture plant in Alabama, which it shared with Toyota. But that plant had finite capacity and was already tasked with producing specific models. To protect its fragile profit margins, Mazda began to inch up its sticker prices while simultaneously shrinking the incentives and rebates it offered to consumers. Of all the smaller players, Mitsubishi faced the steepest and most treacherous climb. Lacking any significant U.S. production capacity, its business model was almost entirely dependent on importing its vehicles. The brand's primary appeal to American consumers was its value proposition, offering feature rich vehicles at a lower price point than competitors. Tariffs struck at the very heart of this identity. If Mitsubishi raised its prices to cover the duties, it risked erasing its key competitive advantage and becoming irrelevant in a crowded market. The brutal reality for all these smaller automakers was the same. The walls were closing in. The immense pressure was forcing conversations about radical strategic shifts, deeper alliances, more extensive platform sharing with rivals, or even strategic retreats from certain market segments were all on the table. For some, survival itself was no longer a guarantee. But while its Japanese rivals were reeling, backpedaling, and absorbing body blows, the Hyundai Kia conglomerate made a dramatically different calculation. Instead of playing defense, it went on the offensive. The South Korean powerhouse saw the tariff crisis not as a threat, but as a once in a generation opportunity to seize market share and cement its position in the American automotive hierarchy. The company boldly reset its profit expectations and unveiled an audacious U.S. localization plan that was breathtaking in its scale and ambition. The centerpiece of this strategy was a massive new manufacturing complex in Georgia, a sprawling campus designed to be a fortress against the storms of trade policy. The plan was clear and aggressive. By the year 2030, Hyundai Kia declared over 80% of all vehicles it sold in America would be built in America. The Georgia facility was the key to unlocking this goal, with a target of producing 500,000 units a year by 2028. This was not just another assembly plant. It was conceived as a self contained ecosystem, blending the production of traditional hybrids with next generation EVs and featuring co located battery manufacturing facilities. The message to the market, to consumers, and to competitors was unambiguous. The best way to dodge a tariff is to build cars with local steel, local labor, and local suppliers. Hyundai was betting that American buyers, weary of price volatility and inventory shortages, would reward the company that could offer a stable supply of affordably priced vehicles. This audacious gamble was not without its costs and risks. In the short term, the massive capital expenditure required for the Georgia project, coupled with the ongoing tariff impacts on its existing imported models, forced Hyundai to trim its corporate margin targets. The company warned investors to brace for heavier tariff related financial impacts in the third quarter. The transition also exposed the company to new and unexpected challenges, highlighting the messy collision of trade policy, labor, and immigration. In a widely reported incident, a team of specialist technicians and engineers from Korea who were in Georgia to commission the sophisticated new battery production lines were detained in a federal immigration raid. The event caused significant disruptions and underscored the practical hurdles of executing such a rapid industrial localization. In the aftermath, Hyundai executives began urgently lobbying officials in both Washington and Seoul to create smoother, more reliable travel rules for essential technical workers. Despite these headwinds, Hyundai Kia pressed forward, broadening its product lineup to capitalize on its growing manufacturing might. The company announced an accelerated timeline for more hybrid models, a new generation of extended range EVs due in 2027, and in a direct challenge to Detroit's most profitable segment, plans for a North American built pickup truck before 2030. Its sister brands, Kia and Genesis, were already sharing in the momentum, with the group's combined U.S. capacity already exceeding 1 million units annually. The strategic calculus was a high stakes bet on the future of American trade policy. If the tariffs endured, this early and decisive investment in deep localization could leave Hyundai Kia years ahead of its rivals, who would still be scrambling to untangle their global supply chains. The Georgia gamble was underway, a move that could permanently reshape the competitive landscape of the American auto market. Now, beyond the corporate strategies and boardroom gambles, it's crucial to understand the broader impact this all had on consumers, on the supply chain, and how it created a distinct advantage for Canada. American households felt the direct and painful consequences of the tariffs in their daily lives. The costs flowed through the complex circulatory system of the economy and manifested on the sticker prices at the dealership. The financial burden was delivered through three primary channels. The first was the most obvious: direct duties on fully imported cars, which made a vehicle shipped from Japan or Europe thousands of dollars more expensive overnight. The second channel was more insidious: duties on foreign parts that were used inside U.S. built vehicles. A car assembled in Alabama might be considered domestic, but if its engine, transmission, and infotainment system were imported, the tariffs on those components were baked into the final cost of the American made car. The third channel was the increased price of raw materials, as tariffs on foreign steel and aluminum drove up the cost for all manufacturers, foreign and domestic alike. Few, if any, models were able to meet the stringent exemption thresholds for domestic content without undergoing expensive and time consuming redesigns. Automakers were caught in a bind. Some chose to raise sticker prices directly. Others tried to obscure the cost increase by decontenting their vehicles, trimming features that were once standard, like advanced safety systems or premium audio. A third tactic was to lean heavily on dealer incentives and subsidized financing just to keep sales moving, a strategy that ate directly into their already razor thin margins. The true fallout, however, was most visible in the used car market. As new car prices outpaced wage growth, the supply of trade ins, the primary source of inventory for used car lots, shrank dramatically. The fleet operators held their vehicles longer, and the entire supply of clean, late model used cars simply collapsed. This created a new class of automotive have nots. Buyers with a budget of $28,000 to $35,000, once the ideal range for a new or nearly new compact SUV, were suddenly priced out. They were forced to venture deeper into the older, higher mileage end of the market, settling for crossovers that were years older, had tens of thousands more miles on the odometer, and lacked the modern safety, upgrades, and fuel efficiency of newer models. This squeeze carried significant long term consequences, not just for family budgets, but for overall road safety and environmental emissions. Meanwhile, as the U.S. market grappled with this self inflicted wound, Canada was capitalizing on the chaos with strategic precision. Seeing the instability to the south, the Canadian federal and provincial governments rolled out the red carpet for global automakers. Ambitious, well funded programs were launched to attract every piece of the EV supply chain, from the mining of critical minerals like lithium and cobalt to the construction of massive gigafactories for battery production and the development of sprawling supplier parks, to a global auto industry starved for predictability. Canada offered policy stability and, most importantly, tariff free access to the U.S. market under the USMCA. Each new project announced in Ontario or Quebec was another piece of the North American automotive map that was being tilted northward. The reality became undeniable. Build where you sell was no longer a catchy corporate slogan. In the tariff laden world of 2025, it was the new non negotiable blueprint for survival. But the story runs deeper than corporate balance sheets and North American trade routes. It's etched into the very fabric of the communities left behind. The loss of 42,000 jobs is not just a statistic, it represents a hollowing out of the American industrial heartland on a scale not seen in a generation. For every shuttered assembly plant, there is a cascade of secondary economic devastation. The local diners that once served breakfast to three shifts of workers now struggle to keep their doors open. The family owned hardware stores and auto parts suppliers that depended on factory contracts have seen their revenues evaporate. School districts, heavily reliant on property taxes from both the plants and their well paid employees, face crippling budget shortfalls, leading to teacher layoffs and cuts to essential programs. This is the unspooling of the social contract in slow motion. It's a crisis that creates a dangerous vacuum where economic anxiety festers and breeds political resentment. The damage is not just economic, it's psychological and cultural. These were not just jobs, they were careers that offered a pathway to the middle class, supporting families for generations. The specialized skills of tool and die makers, robotics technicians, and assembly line supervisors' skills honed over decades are now at risk of vanishing from the American workforce. When a factory closes, that institutional knowledge, a vital national asset, often walks out the door with the last worker. This creates a skills gap that cannot be easily or quickly replaced, further diminishing the nation's advanced manufacturing capabilities. Furthermore, this exodus of investment has profound long term technological implications. As Canada positions itself as the North American hub for EV and battery innovation, attracting billions in capital and talent, the United States risks becoming a technological laggard in the most significant automotive transition in a century. While American politicians were erecting trade walls, other nations were building the foundations for the future. The very policies intended to catalyze a renaissance in American manufacturing may have, in a stroke of bitter irony, ensured that the next generation of automotive technology is developed and perfected elsewhere. This is the quiet, grinding cost of the tariff war. Not just the jobs lost today, but the innovation and prosperity forfeited tomorrow. So, what does this all add up to? The final verdict is that America was left walking on a tariff tightrope. The story of 2025 is not a simple narrative of Asian automakers fleeing American shores. It is the story of a violent and chaotic reset of the entire North American manufacturing playbook, a paradigm shift forced by a trade policy that disregarded the intricate realities of a globalized industry. The fallout has created a clear divergence in strategy and fortune among the key players, leaving the industry fractured and the future uncertain. Toyota and Honda, the established giants, are weathering the storm through sheer financial might, absorbing billions of dollars in losses while they furiously scramble to reshore their supply chains and deepen their already substantial local production. They are playing a long game, betting that their brand loyalty and manufacturing prowess can see them through the crisis. But the question remains, how long can they continue to shield buyers from the steep price hikes their balance sheets demand? In stark contrast, the smaller Japanese brands, Nissan, Subaru, Mazda, and Mitsubishi, are cornered. Lacking the scale and resources of their larger rivals, they are forced into a series of painful choices, raising prices and risking the loss of their customer base forging difficult alliances to share costs, or even considering a full retreat from certain market segments. Their struggle is a cautionary tale about the vulnerability of even established companies in the face of sudden geopolitical shifts. Then there is Hyundai Kia, the bold gambler. The company is turning Georgia into an automotive fortress, wagering tens of billions of dollars. That deep and rapid localization is the ultimate trump card in an era of protectionism. If the tariff regime persists, their bet could pay off handsomely, catapulting them to a dominant position in the American market. But if policies shift, they could be left with massive, underutilized capacity, a costly monument to a bygone political moment. For American buyers, the immediate outcome is clear and painful: sticker shock at the new car dealership, dwindling choices, and inflated prices in the used car market, and a pervasive uncertainty about when or if affordability will return. For American workers, the future is a race against time. The next wave of well paying factory jobs will not be determined by legacy or loyalty, but will follow whichever companies and whichever regions can rebuild resilient, cost effective supply chains inside North America the quickest. Whether the heart of that future lies in Michigan, Georgia, or increasingly in Quebec, the real race is about speed and scale. And in the unforgiving world of 2025, the clock is already ticking.